So let's bring in here Stephen Miller, a fixed interest specialist and now an investment strategy advisor at GSFM. Always good to chat to you, Stephen.
Nice to meet you, Ross.
Let's go to that very point. The Reserve Bank here has barely dented consumer demand. And yet, if suddenly there's a signal that the rates and the rate rises are coming to an end, you know what's going to happen. People are just going to keep on spending. Inflation might be more difficult to dislodge than the Reserve Bank would prefer.
Oh, I think we're already seeing signs of that. And I'm not quite as sanguine as the previous speaker on US inflation. You know, I think it's certainly coming down, but not at anywhere near the rate that I think the Fed had hoped for. Locally, I think what the problem the RBA has is it wasn't as aggressive as other central banks in tackling inflation through 2022. And now it faces an inflation rate that's probably significantly higher, at least in trim mean or core terms, than what are confronted by other central banks. So the Bank of Canada can pause credibly because it raised 425 basis points last year. The Fed can signal that it maybe has one more and done. The Bank of England will probably raise tonight. And because the RBA has been lagging all those banks that I've just mentioned, and given the data that we've had out since Philip Lowe enunciated data dependence as the key metric, I don't think the RBA has got any other choice but to again raise rates when it meets in April. And again, that reflects that it was slow out of the gates in 2022.
OK, and there's a different thing for, say, the European Central Bank or the US. With their banking systems wobbling, that gives them a cause for pause. Here in Australia, the banks are unquestionably strong and therefore it doesn't face the same problems that overseas markets do.
That's exactly right. So, you know, the ripples do get here, but we're on the periphery of the pond. We're not at the centre of the pond like the US or the Europeans are. And the inflation challenge is higher here. So, and notwithstanding the banking challenges in the US and Europe, the ECB increased by 50, the Fed increased by 25, the Bank of England will probably increase by 25 basis points tonight. So not only have we been less aggressive than those three I've already mentioned, it'll look even more, we'll look even more out of kilter when we've got a relatively higher inflation rate, relatively lower interest rates, if we don't increase rates at the April 4th meeting.
OK, and if they do pause at the April 4th meeting, then that's going to send the dollar falling.
The Aussie dollar, yes.
Which will create more inflation from the imported goods that we create.
Exactly. No. Look, I'm sure Philip Lowe knows this.
Of course he knows
And I think the minutes, we can overinterpret the minutes. You know, he was saying a pause. You know, they're going to consider a pause at the next meeting. Implicit in that is they're going to consider a 25 basis point rate increase as well.
Yes.
Perhaps even a 50, you know, so which I don't think will happen. But so, you know, I think we can overinterpret the pause reference in the March minutes. And I think the RBA's action plan at the moment will be to proceed with a 25 basis point increase. As I say, if you look at the pieces, the sorts of data cited by Philip Lowe, the price data in the NAB survey, the blockbuster employment report last week, 7% increase in unit labour costs in the national accounts, reports that unions are gearing up for wage increases of close to 7% for award-based work.
The inflation in the services side of the economy.
Exactly. So, you know, I cannot see, given the criterion that Philip Lowe has enunciated, that he could do anything other than increase rates.
And what is absolutely true is that the forecast for when inflation will return to the 2 to 3% band by the Reserve Bank has been pushed out and out by the Reserve Bank. And this is a fundamental problem because you don't want inflation higher for longer because, as Philip Lowe himself has said, that damages the economy.
I think that's exactly right. I think about the last 5 inflation forecasts issued by the RBA have had to be recast within a quarter, recast upwards.
Yes.
So, you know, so the RBA has underestimated inflation consistently for the last 15, 18 months. And if you look at the NAB price data in that monthly business survey, that would imply further upside risk to the RBA's inflation forecast issued in February. So again, you know, I think the grounds are there, all the evidence is there. The criterion as enunciated by Philip Lowe is there to enact another increase of 25 basis points when they meet in April.
So in your mind, where is the terminal rate, as they call it, the highest rate that the cash rate will get to in this part of the cycle?
Well, markets are saying there's no more increases.
Well, no, in fact,
staggering.
They're actually now saying that there's a 30% chance of a rate cut, for goodness sakes.
I think that's... maybe it's something wrong with me, but I can't fathom that. I still think, given Australia's inflation performance, given how much we've lagged, given that the RBA prevaricated on occasions on inflation last year, I still think we probably need a 4 handle. So I'm thinking April might not be the last one. There might be another one after that. Takes the cash rate to about 4.1. Still well below Canada, well below New Zealand, below the UK, below the US. So, you know, I don't think I'm sort of, you know, covered in hawk's feathers here.
So very, very quickly, when is the first rate cut then in your mind?
I can't see a rate cut here until at least sometime in 2024.
Stephen, always good to have you on the program. Many thanks for your time today.
Pleasure to be here, Ross. Thank you.
There you go.